I am about to share some information with you that will change your life forever. You will learn how to crack the system that banks have imposed on us and how to use it against them. Look, my friend, people are divided into three groups. The first group uses credit to pay for something when they don't have enough money. These people use credit, and the bank makes money off them. The second group consists of people who do without credit. They have the opportunity to make purchases, buy cars, expensive equipment, etc., with their own funds. They think that it is better not to use credit because it will lead to paying extra credit funds to the bank. And they are partly right. They already have greater financial literacy than the first group of people. There is also a third group of people who know the big secrets that allow them to manipulate the banking system and the entire economy in general, becoming richer and multiplying their wealth. They earn money from both the first and second groups of people, but most importantly, they have broken the banking system and are making money from it. In this video audiobook, we will talk about compound interest, real estate, how to use bank loans wisely, and how to make sure that you put in as little effort as possible and let the loans work for you without your involvement. The lie you were told about debt is not your enemy. That's the first truth most people are too afraid to say out loud. You were trained to fear it, conditioned to avoid it, programmed to believe that borrowing money is weakness. But here's the brutal truth. The wealthy don't avoid debt. They weaponize it. And the difference between the middle class and the elite is not income. It's leverage. Welcome to Make the Bank Work for You. This is not about reckless borrowing. This is not about financing luxuries you cannot afford. This is not about credit card roulette. This is about using the system against itself. Because the system was not built for employees. It was built for owners. And loans are the bridge. Let me ask you something. If debt is so dangerous, why do corporations use billions of dollars of it? Why do billionaires finance assets instead of paying cash? Why do banks eagerly lend to people who already have money? Because they understand something you were never taught. Debt is not the trap. Uneducated debt is. There are two types of borrowers in this world, the desperate and the strategic. The desperate borrow to consume. The strategic borrow to control. And control is where wealth lives. When you borrow for consumption, you become smaller. When you borrow for acquisition, you become larger. That's the dividing line. Most people use loans to buy liabilities, cars, vacations, clothes, lifestyle upgrades, and every payment makes them poorer. But the wealthy? They borrow to buy assets, cash-flowing property, revenue-generating businesses, equity-producing systems. They borrow money to make more money, and the bank becomes their silent partner. Think about that. The same institution that profits from most people's financial ignorance becomes a tool in the hands of the informed. Debt is not slavery. Irresponsible debt is. There is a massive psychological shift you must make before you can even think about using loans strategically. You must stop thinking like a consumer. Consumers ask, what can I afford monthly? Investors ask, what does this asset return annually? That one question changes everything. A consumer sees a $50,000 car with a $700 monthly payment. An investor sees $700 per month and asks, what asset could I control with that payment that pays me back? That shift is the beginning of financial power. You were told to avoid debt, but no one told you how the rich use it. They understand leverage. Leverage is control without ownership. It is commanding a $500,000 asset with $100,000. It is using other people's capital to expand your financial footprint. It is accelerating time. Because here's the secret. Without leverage, wealth is linear. With leverage, wealth becomes exponential. Let's break it down. If you save $20,000 per year, it will take you 25 years to accumulate $500,000. That's linear growth. But if you use $20,000 as a down payment on an appreciating asset, you control something far larger. You compress time. And time is the most valuable currency in existence. The middle class trades time for money. The wealthy use money to control time. That's what loans allow you to do, if you understand the rules. But before we move forward, you must hear this clearly. Loans magnify discipline. They do not fix stupidity. If you are reckless, debt will destroy you. If you are calculated, debt will elevate you. The same tool, different outcomes. It's not about the loan, it's about the operator, you. In this audiobook, we are going to dismantle the myths. We will talk about borrowing for assets, not lifestyle risk management, understanding spread fixed versus variable rates, inflation advantage, psychological control, strategic repayment, credit score, positioning, cash flow engineering, and how to structure debt so it pays itself. Because once you understand this, you stop fearing the bank and you start using it. You stop working harder and you start working smarter. You stop avoiding leverage and you start designing it. This is not about cheating illegally. This is about understanding the game better than the average player. The rules are public, but very few read them. Debt is like fire. In the wrong hands, it burns the house down. In the right hands, it powers the engine. Most people are burned because they were never taught how to control the flame. You will be. By the end of this audiobook, you will not look at loans the same way. You will not fear interest the same way. You will not see banks as predators. You will see them as fuel stations. And fuel is not evil. It's neutral. The vehicle determines the destination. Here is the uncomfortable truth. If you refuse to understand leverage, you will always build wealth slower than those who do. You can avoid debt your entire life. You can pay cash for everything. You can feel safe. And you will likely remain financially average. Or you can learn to use debt strategically, not emotionally, not impulsively, not greedily, but intelligently. This is not about being flashy. It's about being financially lethal. It's about building machines that produce cash flow. It's about controlling assets that outgrow their cost of capital. It's about making the bank finance your expansion instead of financing your consumption. And once you cross that mental line, you never go back. So let's ask the real question. What if the reason you fear loans is because you were never shown how to use them? What if the real problem is not debt, but ignorance? And what if mastering this changes everything? In the next section, we're going to break the first unbreakable rule, the rule that determines whether debt makes you richer or ruins you. Borrow for acquisition, never for ego. And the line between those two is thinner than you think. Dear friend, allow me to interrupt for a moment. Our team is currently working on improving our channel and videos. May we ask you, dear viewer, what you like about our videos, or perhaps what you would like to see in our videos? Perhaps a different video format or a different format for presenting audiobooks. Be skeptical. Your skeptical expert opinion can help us improve our videos even more. Thank you very much. We look forward to your comments under the video. Let's continue. Chapter 2. The first rule: borrow for acquisition, never for ego. There is a line. It's invisible. It's subtle. And most people cross it without realizing. On one side of the line is strategic debt. On the other side is ego debt. One builds empires. The other builds stress. And the difference between them is not the loan amount. It's the intention behind it. You must understand this before anything else. Debt used for ego is financial poison. Debt used for acquisition is financial leverage. Let's define acquisition properly. Acquisition means control of something that produces, not something that impresses, not something that depreciates, not something that temporarily elevates your image, but something that creates measurable, recurring value. The wealthy do not borrow to look powerful. They borrow to become powerful. And those two paths lead to completely different destinations. Here's the trap. Most consumer debt feels justified. You tell yourself, I need this car for work. I deserve this vacation. I've earned this upgrade. I'll pay it off quickly. And maybe you will. But that's not the point. The point is this. Does the debt generate income? If the answer is no, you are feeding the machine instead of building your own. Let's go deeper. When you borrow for ego, the cash flow moves one direction, out of your pocket. When you borrow for acquisition, cash flow moves two directions, into the asset and back to you. That's the test, every time. Let's imagine two people. Person A takes a $50,000 loan to buy a luxury SUV. Person B takes a $50,000 loan as a down payment on a small rental property. Both owe the bank. Both have monthly payments. But here's where it diverges. Person A makes the payment from their salary. Person B's tenant makes the payment from rent. Same debt. Different structure. One drains, one builds. One makes you dependent on your job. One reduces your dependence over time. That is the difference between borrowing emotionally and borrowing strategically. Now let's talk about ego. Ego debt is sneaky. It doesn't scream bad decision. It whispers. It tells you you're behind. Everyone else is upgrading. You should be further by now. You deserve more. And you respond by financing lifestyle instead of building leverage. You mistake visibility for progress. But wealth is rarely visible in the beginning. It is built quietly, strategically, methodically. The wealthy don't upgrade their lives when their income increases. They upgrade their asset base. There is a discipline required here because borrowing for acquisition requires patience. It often means delaying gratification. It often means saying no to lifestyle upgrades. It often means looking average while building something powerful underneath. That is not weakness. That is financial maturity. Let's break acquisition into categories. There are only a few types of debt that truly qualify as strategic. 1. Cash flowing real estate. 2. Businesses with proven revenue. 3. Revenue generating equipment. 4. Scalable digital assets. 5. Appreciating investments with positive spread. Notice what is missing. Cars, clothes, entertainment, furniture, vacations. None of those produce income. None of those create leverage. None of those improve your net cash position. They only improve perception, and perception does not pay interest. Here is the brutal truth. If the asset does not outpace the cost of capital, you are not leveraging. You are financing. And financing consumption is how the middle class stays middle class. Now let's talk about spread. Spread is the difference between what the debt costs you and what the asset earns you. If you borrow at 6% and your asset returns 12%. You have a 6% positive spread. That is wealth-building math. If you borrow at 7% and your asset returns nothing, you have a 7% guaranteed loss. That is lifestyle math, and lifestyle math compounds downward. The wealthy analyze before they borrow. They don't ask, "Can I afford the payment?" They ask, "What is the projected return? What is the downside risk? What happens if income drops? What happens if vacancy rises? What happens if rates shift?" They stress test the numbers. They don't hope. Hope is not a financial strategy. Emotion is not a financial strategy. Ego is not a financial strategy. Precision is. You must detach your identity from your purchases. The moment your identity becomes tied to what you own, you are vulnerable. The moment your ego demands upgrades, you are manipulable. And banks love manipulable borrowers, but they respect disciplined ones. Here's something few people say out loud. The bank does not care what you buy, they care that you pay. Whether you buy a rental property or a jet ski, they collect interest. But only one of those choices improves your financial position. And here's the shift that changes everything. Start seeing loans as tools for control, not tools for comfort. Control of assets, control of cash flow, control of appreciation, control of inflation advantage, control of time. Because time is the real currency. When you borrow to acquire assets, you compress decades into years. When you borrow to consume, you extend decades of payments. One accelerates freedom, the other delays it. There is a sentence you must internalize. Debt is neutral. Your intention gives it direction. If your intention is ego, debt will expose you. If your intention is acquisition, debt will empower you. And that is the first rule. Borrow for acquisition, never for ego. But here's where it gets more powerful. Even acquisition debt can destroy you if you borrow too much. And that brings us to the second rule. Leverage is power. Overleverage is collapse. And the difference between them is discipline. In the next section, we are going to dissect risk. Because leverage without risk control is gambling, and we are not gamblers, we are architects. Dear viewers, write which city you're from. It's interesting to see which corners of the world are watching our videos. Chapter 3. Leverage is power. Overleverage is collapse. There is a reason empires fall. It is not lack of ambition. It is not lack of opportunity. It is not even lack of intelligence. It is excess. Excess risk, excess expansion, excess confidence, and in finance, excess leverage is the fastest way to go from powerful to bankrupt. Understand this clearly. Leverage magnifies everything: returns, growth, momentum, and mistakes. The same force that accelerates your wealth can accelerate your collapse. So before you ever borrow strategically, you must understand risk. Because smart debt is not about boldness. It is about controlled boldness. Most people misunderstand leverage because they only see the upside. They see appreciation. They see rental income. They see equity growth. They see business expansion. But they rarely ask, what happens if the income stops? What happens if the asset drops in value? What happens if the market shifts? What happens if interest rates rise? This is where the wealthy separate themselves from the reckless. They plan for the downside first, not the upside. Hope is for amateurs. Risk management is for professionals. Let's talk about overleverage. Overleverage happens when your debt obligations exceed your flexibility. It's when one small disruption becomes catastrophic. It's when a vacancy turns into a crisis. It's when a rate increase becomes suffocation. It's when you have no margin. Margin is survival. Margin is the space between your income and your obligations. Margin is breathing room. And without breathing room, you panic. And panic destroys logic. Imagine this. You buy 3 rental properties. Each one barely breaks even. You have no cash reserves. Everything works as long as everything works. But then one tenant stops paying. Suddenly, you're covering that mortgage from your personal income. Then a repair hits. Then interest rates adjust upward. Now your investment is draining you. This is not a leverage problem. This is a margin problem. You borrowed without cushion. You expanded without defense. And leverage exposed your fragility. Here's the rule. Never borrow to the maximum of what you qualify for. Banks approve based on risk models that protect them, not you. They don't care if your lifestyle becomes tight. They care that you remain statistically capable of paying. You must be more conservative than the bank. If they approve you for $500,000, ask yourself if $350,000 is safer. If they approve 5 properties, ask if 3 is wiser. Overleverage is fueled by greed. Strategic leverage is fueled by patience. Now let's talk about the emergency factor. Every leveraged asset must have a buffer. Cash reserves, 6 months minimum of payments, preferably more, because leverage works best when you are calm, not desperate. Desperation forces bad decisions. You sell too early, you refinance poorly, you panic. The wealthy do not panic because they structure for stability. They assume something will go wrong, they expect fluctuation, they respect volatility. You must do the same. Let's discuss cash flow. Never rely solely on appreciation. Appreciation is speculative. Cash flow is survival. If the asset pays you monthly, it strengthens you. If it only increases in value on paper, it tempts you. Paper wealth is dangerous if unsupported by income. If you borrow for an appreciating asset that produces no cash flow, you are betting on timing, and timing is unpredictable. But when an asset generates income that covers its own debt, that is stability. That is self-liquidating debt. The asset feeds itself, and that is the goal. Now let's talk about interest rate structure. Fixed rate debt is predictable. Variable rate debt is exposure. When you borrow with a variable rate, you are adding a layer of uncertainty. Sometimes that risk is worth it, often it is not. The wealthy love fixed rate debt during inflationary periods because inflation erodes the value of their repayment. If your payment is fixed for 30 years, but income rises with inflation, your debt becomes lighter over time. You are repaying with weaker dollars. This is a silent advantage, but if your rate floats upward, your margin shrinks. So structure matters. Debt is not just about amount. It's about terms. It's about flexibility. It's about protection. Here's another critical principle. Never stack short-term debt on long-term assets. If you finance a long-term appreciating asset with short-term obligations, you create timing risk. If your debt matures before your asset stabilizes, you are forced into bad refinancing. Match your debt duration to your asset duration. This is how professionals operate. Now let's discuss psychological leverage. The moment your debt controls your emotions, you are no longer in control. If you check interest rates daily with anxiety, you borrowed too much. If you lose sleep over payments, you borrowed too aggressively. Debt should feel calculated, not crushing, because when you are calm, you make intelligent decisions. When you are stressed, you react. And reacting financially is dangerous. Let's define the golden equation. Cash flow greater than debt obligation, reserves greater than unexpected expenses, income diversity greater than single dependency, fixed terms greater than unpredictable shifts. If those equations are in your favor, leverage becomes an accelerator. If not, leverage becomes a weapon against you. The wealthy are not fearless. They are prepared. They don't eliminate risk. They manage it. And here's the mindset shift. Leverage is not about speed. It's about scale. And scale without foundation collapses. You are not trying to impress anyone. You are trying to build something durable. Durable wealth outlasts markets. Durable wealth survives recessions. Durable wealth thrives under pressure, and pressure reveals structure. Now ask yourself, are you building fast or building strong? Because smart leverage is controlled expansion. Overleverage is ego expansion, and ego is the most expensive liability of all. In the next section, we're going to go deeper into the mathematics of spread, because once you truly understand how to calculate the difference between cost of capital and asset yield, you stop guessing. You start engineering, and engineering wealth is far more powerful than chasing it. Chapter 4, The Mathematics of Spread, where wealth is engineered. If you do not understand spread, you are gambling. If you do understand spread, you are engineering. And wealth is not built by gamblers. It is built by engineers. Let's simplify this. Spread is the difference between the cost of your debt and the return of your asset. That's it. Nothing mystical, nothing emotional, just math. But this math decides whether you become powerful or trapped. Here's the formula. Asset yield minus cost of capital equals spread. If the result is positive and stable, you are building wealth. If the result is negative, you are financing your own decline. Now, let's break this down clearly. Imagine you borrow $200,000 at 6% interest. That means your capital costs you $12,000 per year. Now imagine the asset you purchase produces $24,000 per year in net income. $24,000 minus $12,000 equals $12,000 positive spread. That $12,000 is leverage profit. You made money using money that wasn't yours. That is power. But let's flip it. If the asset produces only $10,000 per year, you now have a negative spread of $2,000. You are subsidizing the asset. You are feeding it instead of it feeding you. This is why understanding numbers is everything. Hope doesn't matter. Optimism doesn't matter. Intentions don't matter. Math matters. The wealthy do not fall in love with properties. They fall in love with numbers. They don't care if it's beautiful. They care if it performs. They don't care if it impresses friends. They care if it produces cash flow. Let's go deeper. There are two kinds of yield: cash yield and total return. Yield. Cash yield is what hits your bank account. Total return includes appreciation. Cash yield protects you. Appreciation rewards you. If you borrow based purely on appreciation, you are speculating. If you borrow based on cash flow, you are stabilizing. And stability is what allows you to survive downturns. Now here's where it becomes strategic. Let's say inflation is running at 5%. Your fixed rate loan is 4%. Your asset appreciates at 6%. Your rental income increases with inflation. Your loan payment stays fixed. You are winning on multiple levels. Your asset grows faster than your debt cost. Inflation reduces your real repayment burden, rental income rises over time, your equity compounds. This is the invisible advantage of leverage during inflationary cycles, but only if your spread is positive. Now let's talk about risk-adjusted spread. Because not all spreads are equal, a 4% spread in a volatile business may not be worth the risk. A 2% spread in stable real estate with strong tenants may be more powerful long-term. Spread must be evaluated alongside volatility. Here's the principle. The safer the asset, the smaller the spread required, the riskier the asset, the larger the spread required. This is where discipline enters. If you borrow at 8%, your asset better return more than 8%, and not on a good month, on average, consistently. Stress tested. Here's how you stress test. What if revenue drops 20%? What if expenses rise 10%? What if vacancy lasts 3 months? What if interest increases upon refinancing? Does the spread survive? If yes, proceed. If no, wait. Waiting is not weakness. Waiting is strategic patience. Let's talk about the most common mistake people make. They calculate gross income, not net. Gross rent is not cash flow. Gross sales are not profit. You must subtract operating expenses, maintenance taxes, insurance, vacancy allowance, management fees, unexpected repairs. Then calculate yield. This is not pessimism. This is realism. The wealthy assume friction. Amateurs assume perfection. Now here's something powerful. Spread compounds. If you create a $10,000 annual positive spread and you use that $10,000 to acquire another asset, that spread grows, then multiplies, then accelerates. This is how leverage builds momentum. One asset creates cash flow. Cash flow funds next acquisition increases spread. Spread increases speed. Speed increases opportunity. This is how you make the bank finance your expansion, not your lifestyle. But here is the uncomfortable truth. Many people chase big spreads and ignore sustainability. A risky 15% projected return is not superior to a stable 7% if volatility destroys consistency. Consistency builds wealth. Spikes build stories. Stories don't pay bills. Consistency does. Here's another concept. The debt snowball for assets. Most people use extra cash to upgrade lifestyle. Instead, use positive spread to eliminate weaker debt. Strengthen your balance sheet, increase margin, then expand again. This is controlled expansion, not chaotic growth. Remember this, spread is not just about return. It is about control. If your spread disappears under pressure, you lose control. If your spread survives downturns, you remain calm. And calm investors win long-term. Now let's talk about leverage stacking. Once you understand spread, you can layer intelligently. Example, property A generates $8,000 positive annual spread. You use that spread to cover payments on property B. Property B begins producing $12,000 spread. Now, your system produces $20,000 annually. You didn't inject new salary, you reinvested spread. This is how the wealthy compound without working more hours. Now here's the psychological shift. Stop asking, how much debt do I have? Start asking, what is my net positive spread? Debt alone means nothing. Net spread defines position. A person with $2 million in debt and $300,000 annual positive spread is powerful. A person with zero debt and zero assets is safe, but stagnant. Safety without growth is stagnation. Growth without control is collapse. Spread is balance. It is the bridge between ambition and discipline. Now understand this deeply. Banks calculate risk. You calculate spread. If you understand spread better than the bank understands risk, you gain advantage because you are not borrowing emotionally, you are borrowing mathematically, and math does not panic. In the next section, we will explore inflation because inflation is either your silent enemy or your silent ally, and leverage determines which side you stand on. Dear viewers, please write in the comments what assets you buy or are interested in. Perhaps these are stocks or maybe cryptocurrency. It is interesting to see how you structure your investment portfolio. Also, please write what you think about real estate. Is it still relevant to buy flats today? Chapter 5. Inflation, the silent enemy, or your greatest ally. Inflation is not just rising prices. It is a silent transfer of power. Every year, quietly, invisibly, your money buys less. Groceries rise, rent rises, construction costs rise, wages eventually rise. But debt, if structured correctly, debt stays the same. And that is where leverage becomes a weapon. Most people experience inflation as pain. They feel squeezed. Their cost of living increases. Their salary lags behind. Their savings lose purchasing power. But asset owners, they experience inflation differently because inflation punishes savers and rewards debt holders. If the debt is fixed and tied to appreciating assets. Let's break this down clearly. Imagine you take out a 30-year fixed mortgage. Your payment is $1,500 per month, locked, stable, unchanging. Now imagine inflation runs at 4 to 5% per year. 10 years from now, $1,500 feels smaller because your income has likely risen. Rental income has likely risen. Property value has likely risen. But your debt payment, still $1,500. Inflation erodes the real value of your repayment. You are paying tomorrow's debt with weaker dollars. That is not accidental. That is strategic positioning. Now flip the perspective. If you hold cash, inflation erodes it. If you avoid debt completely, but fail to acquire appreciating assets, inflation silently taxes you. This is why wealthy investors love long-term fixed debt during inflationary cycles, because they understand something critical. Inflation inflates asset prices. Real estate rises. Businesses raise prices. Stocks adjust upward, but debt remains nominally constant. That gap is power. Let's make this tangible. You borrow $300,000 today. In 15 years, inflation has reduced the purchasing power of money significantly. That $300,000 you borrowed feels like less, but the property you purchased may now be worth $500,000. $600,000, maybe more. And rents have increased. Cash flow has increased. Equity has expanded. Inflation punished the person holding cash, but rewarded the person holding appreciating assets financed with fixed debt. This is not cheating. This is understanding monetary policy. Governments inflate currency. Banks lend currency. Investors deploy currency. The question is, are you on the defensive side of inflation or the offensive side? Now be careful. Inflation only benefits you if your debt is fixed rate, your asset appreciates or produces income, your cash flow remains positive, your spread survives rate environments. If you hold variable rate debt during inflation spikes, your payments can increase, your margin shrinks. That is risk. This is why structure matters. Fixed-rate debt during inflationary periods is strategic. Short-term adjustable debt during unstable cycles can be dangerous. The wealthy don't just borrow. They structure, They align their debt duration with economic cycles. They think long-term. Now here's the deeper truth. Inflation rewards scarcity. Assets that are scarce rise faster. Land in desirable areas, cash flow in properties in strong cities. Businesses with pricing power. Assets that can raise prices with inflation. If you borrow to acquire assets that lack pricing power, inflation may not help you. If you borrow to acquire assets that adjust with inflation, you win. Now let's address something critical. Many people say, I don't want debt, I want peace. But what if debt, structured correctly, creates peace? Because here's the psychological difference. If you rely solely on your job income, inflation pressures you constantly. Your rent rises. Your mortgage rises, if adjustable. Your cost of living rises. You feel squeezed. But if you own assets financed at fixed rates, your income rises with inflation. Your debt remains constant. Your equity grows. Inflation works for you instead of against you. This is not about chasing inflation. It is about positioning intelligently within it. Let's talk about equity growth. Every mortgage payment reduces principal. Every year of inflation increases asset value. This creates an expanding equity gap. Equity is optionality. Optionality is freedom. You can refinance. You can sell. You can leverage again. You can reposition. Inflation becomes a force multiplier, but only if you have control of appreciating assets. And control is often achieved through leverage. Now let's discuss another angle. Businesses. If you borrow to acquire or expand a business, and that business can raise prices with inflation, your revenue increases, but your debt payment stays fixed. Your margins expand. Your repayment burden shrinks in real terms. This is how smart entrepreneurs grow during inflationary periods. They lock in debt at fixed rates, then let inflation inflate their revenue. But again, only if spread remains positive, only if cash flow is strong, only if risk is managed. Here's the psychological trap. Many people panic during inflation. They freeze. They avoid investing. They hoard cash. And that hesitation costs them. Because inflation does not wait. It erodes silently. Wealth is built by positioning ahead of macro shifts, not reacting emotionally to headlines. The wealthy understand cycles. They don't fight inflation. They harness it. Now here's a critical caution. Do not use inflation as justification for reckless borrowing. Inflation is a tailwind, not a parachute. If your asset is weak, inflation won't save you. If your structure is unstable, inflation can expose fragility. But when properly structured, inflation is an invisible ally. The middle class complains about rising prices. The investor calculates opportunity. Same environment, different positioning. Now ask yourself honestly, are you positioned defensively or offensively? Are you hoping inflation slows or benefiting when it rises? Because in modern economies, inflation is not an anomaly. It is policy, and policy favors asset holders. The question is, will you be one? In the next section, we're going to talk about something even more powerful, credit positioning. Because leverage is not just about borrowing. It's about becoming someone banks compete to lend to. And when the bank chases you, the game changes. Chapter 6. Become the borrower, banks. Compete. For there is a massive difference between asking for a loan and being offered one. One position is weak. The other is powerful. Most people walk into banks hoping to be approved. The wealthy walk in negotiating terms. That shift changes everything because leverage is not just about using loans. It's about becoming the kind of borrower lenders fight to finance. Understand this clearly. Credit is a weapon, but only if you know how to sharpen it. Banks do not fear debt. They fear risk. And your job is to reduce perceived risk until lending to you becomes attractive. Let's break this down. When you apply for a loan, the bank analyzes credit score, debt-to-income ratio, cash reserves, asset quality, income stability, risk exposure. They are not judging your dreams. They are evaluating probability. The probability that you repay, the probability that the asset performs, the probability that they win. Your job is to tilt probability in your favor. And here's the first mindset shift. Stop seeing your credit score as a number. Start seeing it as leverage capacity. A strong credit profile lowers your cost of capital. Lower cost of capital increases spread. Increased spread accelerates growth. It's all connected. Now let's talk about discipline. Pay everything on time. Always. Not because it's moral, because it's strategic. A single late payment can increase your borrowing cost. A higher borrowing cost shrinks your spread. A smaller spread weakens your leverage. Everything matters. Now let's talk about utilization. High credit utilization signals stress. Low utilization signals control. You want banks to see you as stable, calm, predictable, not stretched. Never max out credit lines, even if you can. Availability of capital is more powerful than desperation for capital. Next, diversify credit intelligently. A mix of installment loans and revolving credit strengthens profile depth. But don't open accounts impulsively. Every inquiry matters. Every line affects structure. The goal is not to collect credit. The goal is to optimize borrowing power. Now here's something most people ignore: liquidity. Cash reserves are strength. Banks respect borrowers who don't need them. If you walk into a bank with zero reserves, you look dependent. If you walk in with 6 months of expenses liquid, you look controlled. Leverage loves liquidity because liquidity absorbs shocks. Now let's talk about income presentation. Stable, documented income increases approval strength. But here's the strategic layer. If you are self-employed, structure income intelligently. Understand how lenders evaluate tax returns. Sometimes reducing taxable income aggressively can reduce borrowing power. You must balance tax strategy with leverage strategy. Wealth is holistic. Now let's talk about relationships. Large borrowers build relationships with lenders. They don't shop blindly. They cultivate rapport, because relationship lending often results in better terms. Better terms equals lower cost of capital. Lower cost of capital equals stronger spread. Spread equals growth. See the pattern? Everything loops back to math. Now here's the powerful shift. When banks compete to lend to you, you choose the structure. You negotiate rates. You request longer terms. You demand fixed rate options. You protect margin. That's power. But here's the truth. Most people never reach this level because they misuse credit early. They burn reputation. They chase consumption. They default. They overextend. And rebuilding takes years. Credit is slow to build, fast to damage. Treat it like a financial reputation, because that's exactly what it is. Now let's talk about something deeper: psychology. When you know you have access to capital, you think differently. You move differently. You negotiate differently. You see opportunity faster, because leverage potential expands vision. But never confuse access with obligation. Just because you can borrow does not mean you should. Discipline remains king. Let's discuss strategic timing. Borrow when terms are favorable. Refinance when rates drop. Extend duration when inflation favors fixed structures. Shorten duration when minimizing interest burden becomes priority. Borrowing is not static. It's dynamic. Wealth builders adjust. Consumers commit blindly. Now here's something critical. Never become emotionally attached to a lender. If better terms exist elsewhere, move. Loyalty in finance must serve you, not sentiment, but maintain professionalism. Because reputation travels, especially in business financing. Now let's talk about positioning beyond credit score. Assets themselves strengthen borrowing power. If you already control cash-flowing assets, banks see track record. Experience reduces perceived risk. Your first deal is hardest. Your fifth is easier. Momentum compounds. Reputation compounds. Trust compounds. Everything compounds. Now here's the critical question. Are you preparing yourself to borrow intelligently or reacting impulsively when opportunity appears? Preparation precedes leverage. The wealthy prepare before expansion. They strengthen credit before applying. They build reserves before scaling. They optimize structure before acquisition. And because they prepare, they move quickly when opportunity appears. Speed without preparation is chaos. Preparation creates controlled speed, and controlled speed builds empires. Now understand something powerful. Once you reach a certain threshold, banks want you because you are profitable, reliable, predictable. That flips the power dynamic. You are no longer asking permission. You are structuring partnerships. And that psychological shift is massive. The bank becomes a fuel source, not a gatekeeper. But we are not done, because access to capital is useless without intelligent deployment. In the next section, we will talk about deploying debt into assets that actually compound, because access alone does not create wealth. Execution does. Chapter 7. Deploying debt into compounding machines. Access to capital means nothing if you don't know where to place it. Leverage is only powerful when directed into something that compounds, and compounding is the eighth wonder of financial engineering. Because compounding does something magical. It turns time into an ally. It turns patience into momentum. It turns discipline into exponential growth. But here is the brutal truth. Most people who borrow never experience compounding because they deploy capital into static assets, or worse, into depreciating liabilities. You must understand this. Not all assets compound. Some produce, some appreciate, some inflate. But only a few truly compound. And if you are going to borrow, you must borrow for compounding engines. Let's define compounding clearly. Compounding happens when an asset produces income. That income is reinvested. That reinvestment produces more income, and the cycle accelerates. This is financial acceleration. Now imagine two investors. Investor A buys a property that barely breaks even. Investor B buys a property with strong positive cash flow. Investor A waits for appreciation. Investor B reinvests monthly profit. After 5 years, Investor B owns more because cash flow compounds. Investor A owns hope. Hope is not compounding. Cash flow is. Let's break down the categories of compounding machines. 1. Cash flowing real estate rental properties that generate monthly profit beyond debt obligations. That profit becomes seed capital. Seed capital funds new acquisitions. New acquisitions increase cash flow. Cash flow accelerates expansion. If structured correctly, this becomes self-fueling growth. 2. Scalable businesses. Businesses that can grow revenue without proportional expense growth. software, digital products, service systems with strong margins. When borrowed capital expands these operations, revenue scales faster than cost. Margins widen, spread increases, reinvestment accelerates. 3. Dividend-producing investments, stable investments that generate consistent income. Reinvest dividends, compound position size, compound yield. But caution here, borrowing to invest in volatile markets requires extreme discipline. Spread must be solid, volatility must be tolerable, margin calls must be avoided. 4. Intellectual property books, courses, licensing, digital media. These require sweat equity, but when scaled with borrowed capital for marketing or expansion, they can compound dramatically. Now here's the principle. You want assets where income grows over time, expenses remain predictable, debt is fixed, demand is durable, durability matters. Compounding requires time, and time requires stability. Now let's address something dangerous. Borrowing into trends. Trends feel exciting, but compounding requires consistency. Speculative assets may spike, but spikes don't compound reliably. Reliability builds empires. Spikes build stories. Stories don't build freedom. Now here's the power move. Use debt to accelerate entry, then use cash flow to accelerate expansion. Example, you acquire one strong asset using leverage. It generates $15,000 annual positive spread. Instead of spending that money, you save until you have another down payment. Acquire again, repeat. This is controlled compounding. Now here's the critical difference between amateurs and professionals. Amateurs consume profits. Professionals reinvest profits. If your leveraged asset produces $1,000 per month and you increase lifestyle by $1,000 per month, you have neutralized leverage. If you reinvest $1,000 per month, you have activated compounding. Discipline determines outcome. Now let's discuss velocity. Velocity of money is how quickly capital moves from profit to reinvestment. High velocity accelerates compounding, but reckless velocity increases risk. Balance matters. Let's say you build 3 properties, each generating positive spread. You now have stable cash flow. Instead of acquiring 5 more immediately, strengthen reserves, improve systems, reduce risk exposure, then expand. Controlled acceleration. Now let's talk about debt layering. Never layer speculative debt on top of unstable cash flow. Each new leveraged position must be supported by stable income. The structure must feel strong, not stretched. Remember, compounding collapses when overextended. Margin is protection. Liquidity is armor. Now here's something powerful. Compounding requires patience. The first year feels slow. The second year builds slightly. Year 5 accelerates. Year 10 explodes. But most people quit before acceleration. They expect immediate transformation. Wealth rarely moves dramatically early. It builds quietly. Then, suddenly. This is why discipline matters more than excitement. Now let's talk about emotional control. When compounding begins, temptation increases. You see profit. You feel success. You want to upgrade lifestyle. But the wealthy delay gratification because they understand this truth. Early lifestyle upgrades kill long-term exponential growth. Reinvest early. Upgrade later. That's the formula. Now here's a deeper concept. Debt plus compounding plus time equals asymmetry. Asymmetry means limited downside, massive upside. If your asset is cash flow positive, your downside is controlled. Your upside is exponential. This is intelligent risk. Now let's talk about long-term vision. Ask yourself, is this asset compounding for 10 years or peaking in 2? Is this market stable Is this demand consistent? Is this structure durable? Compounding loves boring. Boring assets compound best. Flashy assets fluctuate. Fluctuation disrupts compounding. Now here's the strategic insight. When your compounding engine grows large enough, you no longer need aggressive leverage. The system funds itself. At that stage, debt becomes optional, not necessary. But to reach that stage, you must deploy debt intelligently early. Now understand this: leverage is the spark. Compounding is the engine. Time is the fuel. Discipline is the driver. And emotion is the enemy. In the next section, we will address something critical: the psychological war of debt. Because numbers alone do not determine success. Control over fear, greed, and ego does. And without psychological mastery, even the best leverage strategy collapses. Dear viewer, please write in the comments what interested you most in the video. This will help us improve our videos. Chapter 8. The Psychological War of Debt. Before debt ever breaks your bank account, it breaks your mind. Before leverage destroys your balance sheet, it destabilizes your emotions. This is the part nobody talks about. The math can be perfect. The spread can be positive. The structure can be intelligent. But if your psychology is weak, you will sabotage yourself. Because debt amplifies who you are. If you are disciplined, it magnifies discipline. If you are impulsive, it magnifies impulsiveness. If you are fearful, it magnifies fear. If you are greedy, it magnifies greed. And leverage does not forgive emotional instability. Let's talk about fear first. Fear of debt keeps many people small. They avoid leverage entirely. They refuse to borrow. They cling to safety. But safety without growth leads to stagnation. The fear-driven investor never expands, never scales, never compounds meaningfully. They feel secure, but slowly inflation erodes them, opportunity passes them, time outruns them. Now let's talk about the opposite extreme: overconfidence. This is more dangerous. You experience early success. One property performs well. One business scales quickly. You feel invincible. You expand aggressively. You stack debt rapidly. You ignore margin. You underestimate risk. And suddenly, one market shift shakes everything. Confidence turns into panic. Panic turns into forced selling. And forced selling destroys wealth. Both fear and greed are enemies. The goal is emotional neutrality. You must treat debt like a tool, not a thrill, not a threat, a tool. The wealthy are emotionally boring with money. They don't celebrate loans, they don't dramatize payments, they calculate, they execute, they adjust. Let's discuss stress tolerance. If you cannot tolerate temporary fluctuations, leverage will test you. Markets dip, vacancies occur, interest rates shift. News headlines scream recession. If your psychology collapses during volatility, you make bad decisions. You sell at the wrong time. You refinance poorly. You panic liquidate. The wealthy do not react to noise. They analyze structure. If structure remains sound, they remain calm. Calm wins. Emotion loses. Now here's a powerful truth. Debt forces maturity. When you sign a loan, you commit to responsibility. If you treat that commitment casually, you will suffer. If you treat it with respect, you grow stronger. Debt is discipline training. It forces you to track numbers, manage cash flow, build reserves, control spending. If you borrow without discipline, debt becomes chaos. But if you borrow with discipline, debt becomes structure. Structure creates strength. Let's talk about ego again, because ego does not disappear after acquisition. Ego whispers during growth. You're successful now. You deserve more. Scale faster, upgrade lifestyle. And if you listen too soon, you interrupt compounding. Emotional spending kills leverage efficiency. That extra $3,000 per month profit, if spent on lifestyle, it disappears. If reinvested, it multiplies. Now here's a question you must answer honestly. Why do you want leverage? If the answer is status, you are vulnerable. If the answer is freedom, you are grounded. Freedom-focused investors move strategically. Status-focused investors move emotionally, and emotional leverage collapses. Now let's talk about comparison. Debt feels heavier when you compare yourself to others. You see someone debt-free and feel insecure. You see someone scaling aggressively and feel behind. Comparison distorts clarity. Focus on your structure, your margin, your spread, your reserves, your timeline. Wealth is not a race. It is engineering. Now here's the subtle psychological trap. When markets rise, confidence rises. When markets fall, fear rises. But both are temporary. Structure outlasts cycles. If your leverage is built on positive cash flow, strong reserves, fixed rate terms, durable demand, you survive downturns. If it is built on speculation, minimal reserves, high exposure, ego-driven expansion, you suffer. Psychological strength comes from structural strength. Build your balance sheet strong. Your emotions will follow. Now let's discuss patience. Leverage magnifies impatience. If you expect quick transformation, you will feel disappointment. If you expect long-term compounding, you feel stability. Patience stabilizes psychology. Impatience destabilizes it. Remember this: debt accelerates growth, but it does not eliminate time. Time still does the heavy lifting. You cannot force compounding. You can only position for it. Now here's another psychological factor: isolation. When you begin using leverage intelligently, many people won't understand. They may criticize. They may warn you. They may project their fear. You must filter advice carefully. Take input from those who understand structure, not those who only understand caution. Caution without knowledge creates stagnation. Knowledge with caution creates power. Now here's the real battlefield: control over consumption. When your income increases because of leverage, temptation increases. And that is where most investors fail. They confuse early profit with permanent wealth. They increase expenses. They reduce reinvestment. They slow compounding. This is psychological leakage. You must remain disciplined longer than feels comfortable, because wealth compounds slowly, then suddenly. Now understand something critical. Your relationship with debt must be neutral, not emotional, not prideful, not ashamed. Neutral. Debt is neither evil nor heroic. It is arithmetic. Arithmetic does not care about your feelings. It responds to structure. In the next section, we will move into strategic repayment, because at some point, leverage must evolve. Debt must be repositioned. Terms must be adjusted. And knowing when to hold debt and when to eliminate it is the final layer of mastery. Dear viewer, we strive to create high-quality videos for you. Please assist us in improving our efforts by commenting on what you like about the video and what you would change or add. We would be very grateful. Chapter 9. When to hold debt and when to kill it. There comes a moment in every wealth-building journey where the question shifts. At first you ask, how do I get approved? How do I deploy leverage? How do I expand? But later, the smarter question becomes, should I still be holding this debt? Because leverage is a phase, not a religion, and knowing when to hold debt and when to eliminate it is the mark of financial maturity. Let's be clear about something powerful. Debt is a tool for acceleration, not a permanent identity. In the early stages of wealth building, leverage helps you compress time. It allows you to control assets you otherwise couldn't. It multiplies your footprint. It expands your influence. But as assets mature, as equity builds, as cash flow stabilizes, the strategy evolves. Here's the mistake many investors make. They either avoid debt completely out of fear or hold debt indefinitely out of pride. Both extremes lack nuance. Nuance is power. Let's break this down strategically. There are 3 stages of debt in wealth building. Stage 1, acquisition debt. Stage 2, optimization debt. Stage 3, optional debt. Stage 1, acquisition debt. This is when you borrow to enter markets. You use leverage to gain control. You focus on spread. You prioritize compounding. You are aggressive but calculated. Debt is fuel. Stage 2, optimization debt. Now your assets are stable, cash flow is consistent, equity has grown. At this stage, you begin analyzing. Is this debt still optimal? Can I refinance at better terms? Can I extend duration? Can I lower interest? Can I improve cash flow? You're no longer chasing expansion blindly. You're refining structure. Now comes the real mastery. Stage 3, optional debt. This is where many never arrive. At this stage, your assets produce strong cash flow. Your equity is substantial. Your reserves are healthy. You no longer need leverage to survive or expand. Debt becomes optional, and optionality is freedom. Here's the psychological difference. When debt is necessary, it feels heavy. When debt is optional, it feels strategic. Now, let's discuss when to eliminate debt. You eliminate debt when the spread disappears, the interest rate exceeds asset return, risk outweighs reward, peace becomes more valuable than leverage. If you hold debt at 9% and your asset returns 6%, you are losing spread. That debt should be killed. If you are approaching retirement and stability matters more than growth, reducing leverage makes sense. If market volatility increases risk exposure, deleveraging protects you. But here's the key. You eliminate debt strategically, not emotionally. Let's talk about interest math. If you have a loan at 3% fixed and inflation is 5% and your asset produces cash flow, why rush to eliminate it? That debt is cheap. In fact, it may be beneficial to hold it. But if you have high-interest consumer debt, credit cards at 18%, personal loans at 12%, there is no debate. Kill it immediately. That is not leverage. That is financial leakage. Now here's a deeper insight. The wealthy often refinance instead of repay. They reposition debt instead of eliminate it. Example, you own a property worth $600,000. You owe $200,000. Instead of paying off the $200,000 immediately, you might refinance strategically. Pull equity, acquire new assets, increase compounding, but only if spread remains positive. Debt is repositioned, not blindly destroyed. But there is a moment when compounding has done its work, when assets generate more than enough income, when stress tolerance changes, when lifestyle priorities shift. At that point, you may choose to eliminate debt, not because you must, because you can. And that psychological shift is powerful. Let's talk about debt fatigue. Holding debt long-term requires discipline. Even good debt carries responsibility. Some people reach a stage where cash flow is strong, net worth is substantial, and the marginal benefit of leverage is small. At that point, peace may outweigh expansion. This is not weakness. This is evolution. But here's the warning. Never eliminate productive debt too early. If killing a 4% loan prevents you from acquiring a 10% asset, you slowed your growth unnecessarily. Analyze opportunity cost. Every dollar used to pay down debt cannot be deployed elsewhere. Opportunity cost must be calculated. Now, let's discuss strategic debt snowballing. You prioritize highest interest first, then moderate, then lowest. But always evaluate, does this debt still serve my spread? If yes, maybe keep it. If no, remove it. Now here's the subtle psychological trap. Some people rush to eliminate debt because it feels emotionally satisfying. Debt-free sounds powerful, but sometimes financially suboptimal. Again, emotion versus arithmetic. Arithmetic wins. Let's imagine two investors. Investor A pays off all mortgages aggressively. Investor B keeps low-interest mortgages and reinvests profits. 10 years later, Investor B often controls more assets, more cash flow, more equity, because leverage amplified compounding. But if market conditions shift, Investor A may feel more stable. Neither is universally right. Context matters. Goals matter. Timeline matters. Now here's the most important question. What stage are you in? Early-stage wealth builders should focus on intelligent leverage. Mid-stage wealth builders should optimize structure. Late-stage wealth builders may prioritize stability. One strategy does not fit all. Maturity means adjusting. In the next section, we will talk about diversification through leverage. Because once your first compounding engine is stable, you must avoid concentration risk. And concentration risk is where many empires collapse. Friend, write your opinion on this topic in the comments. Do you agree with us or not? I'm interested to hear your thoughts. Chapter 10. Diversify or collapse. The leverage expansion rule. Leverage builds empires. Concentration destroys them. There is a moment in every investor's journey when success becomes dangerous. The first asset works. The second performs even better. Cash flow increases. Confidence rises. Momentum builds. And then complacency whispers. You figured it out. Just repeat the same thing. Double down. And that's when risk hides in plain sight. Because leverage magnifies concentration. If all your debt is tied to one asset class, one city, one market, one industry, one income stream, you are exposed. Not weak, exposed. And exposure is not obvious when markets are rising. It becomes obvious when markets shift. Let's talk about diversification, not the watered-down version, not random investing, strategic diversification. Diversification is not about owning everything. It's about reducing correlated risk. If all your properties are in one neighborhood, a local downturn affects all of them. If all your businesses rely on one client, one cancellation collapses revenue. If all your investments depend on one industry, one disruption threatens your balance sheet. Diversification spreads leverage intelligently. But here's the important distinction. Diversification without mastery is chaos. You must diversify from strength, not from confusion. Let's break this down strategically. Phase 1. Concentrated competence. You master one asset class, one system, one structure. You learn how it behaves. You understand its cash flow, its risk patterns, its cycles. You build foundation. Phase 2. Controlled expansion. Once stable, you expand into adjacent opportunities, not randomly, strategically. Example, if you own residential rentals, Maybe you add small commercial properties. If you operate a service business, maybe you add digital products. If you hold dividend stocks, maybe you add real estate investment trusts. Notice something important. These are complementary moves, not chaotic jumps. Diversification should reduce risk, not increase it. Now let's talk about correlation. If inflation rises, real estate may benefit. If interest rates rise aggressively, certain equities may suffer. If one sector weakens, another may strengthen. Diversification smooths volatility. But here's the mistake many make. They over-diversify too early. They own tiny pieces of too many things. They lose control. They dilute focus. Focus builds initial wealth. Diversification protects mature wealth. Timing matters. Now let's talk about leverage stacking across asset classes. Imagine this structure. Rental properties produce monthly cash flow. Digital business produces scalable income. Dividend portfolio produces quarterly income. Each asset feeds reserves. Each asset strengthens liquidity. Each asset reduces reliance on any single income stream. That is diversified leverage. If real estate slows, digital continues. If digital slows, dividends continue. If dividends slow, rental cash flow stabilizes. Redundancy creates resilience. Resilience protects leverage. Now here's a deeper insight. Debt itself can be diversified. Mix of fixed and short-term, mix of different lenders, mix of secured and unsecured. Why? Because relying on one funding source is vulnerability. If one bank tightens lending, you still have options. Options are power. Let's discuss concentration risk in leverage. If you refinance everything at once and rates spike, you feel it everywhere. If all debt matures simultaneously, you face rollover risk. Stagger maturities. Distribute exposure. Plan ahead. Professionals ladder debt maturities. They don't allow everything to come due in the same year. Why? Because flexibility matters. Now let's address psychological diversification. If your entire identity is tied to one asset. Emotion clouds decisions. If you own only one business, every downturn feels catastrophic. If you own multiple streams, pressure is reduced. Reduced pressure improves decision-making. Now here's something powerful. Diversification allows you to take calculated risks because downside is absorbed. If you know your base cash flow is stable, you can experiment strategically. Innovation becomes possible. Without stability, experimentation becomes reckless. Let's discuss scaling intelligently. Once your initial compounding engine is strong, don't immediately triple it. Add one adjacent pillar, stabilize, then expand further. Controlled expansion beats aggressive stacking because leverage loves balance. Now here's the harsh truth. Many investors collapse not because of bad assets, but because of overconfidence in one system. They believe one model will work forever. Markets change, technology disrupts, regulation shifts, diversification anticipates uncertainty. It does not predict it. It prepares for it. Now, here's the real secret. True diversification isn't just about assets. It's about skills. If you understand real estate deeply, learn business fundamentals. If you understand markets, learn cash flow modeling. If you understand investing, learn risk management. Knowledge diversification strengthens structural diversification. The wealthy are not just asset diverse, they are knowledge diverse. And knowledge reduces blind spots. Now, let's talk about defensive positioning. When markets feel overheated, increase liquidity. When markets crash, deploy liquidity. Diversification gives you flexibility to act. Without it, you freeze. Flexibility wins long term. In the next section, we are going to talk about something even more subtle, the role of timing in leverage. Because knowing when to enter, when to pause, when to refinance, when to expand, is where true strategic intelligence lives. Chapter 11, Timing the Market versus Timing Your Structure. There is a dangerous obsession in the financial world. Is this the right time to buy? Are rates too high? Is the market overheated? Should I wait? And while everyone argues about timing the market, the wealthy focus on something far more powerful, timing their structure, because markets move in cycles. But structure determines survival. Let's make this clear immediately. You cannot perfectly time markets, but you can perfectly control your preparation, and preparation beats prediction every time. Most people delay action waiting for ideal conditions, low interest rates, high appreciation forecasts, bullish headlines. But perfect conditions are visible only in hindsight. By the time certainty appears, opportunity has already moved. The wealthy do not wait for perfection. They build flexible structures that work across cycles. Let's break down cycles. Expansion, peak, contraction, recovery. Every market moves through these phases, but leverage reacts differently in each one. During expansion, credit is cheap, confidence is high, assets rise, borrowing is easy. This is where many become reckless. They expand aggressively. They assume momentum will continue, but expansion is not permanent. During peak, prices feel unstoppable. Greed is widespread. Risk tolerance is inflated. This is when disciplined investors slow down. They don't stop. They become selective. During contraction, fear spreads, prices soften, credit tightens, opportunities quietly emerge. This is where prepared investors deploy capital, because while others panic, they acquire at discount. During recovery, confidence rebuilds, stability returns, early movers benefit. Timing is less about predicting phases, more about preparing for them. Here's the powerful truth. If your leverage only works in expansion, it is weak leverage. If your leverage survives contraction, it is intelligent leverage. Structure greater than timing. Now let's talk about interest rates. People obsess over rates. Yes, but rates are high. High relative to what? Rates fluctuate historically. Sometimes 3%, sometimes 7%, sometimes more. The question is not simply, is the rate low? The question is, does the spread work? If you borrow at 7%, but your asset yields 12%, spread is positive. If you borrow at 3%, but your asset yields 2%, spread is negative. Low rates do not guarantee good investments. High rates do not eliminate opportunity. Spread decides viability. Now here's where timing becomes strategic. If rates are high but fixed, and inflation is rising, locking in fixed debt can be powerful. If rates are temporarily elevated, you may refinance later. Structure with flexibility, never structure with hope. Now let's discuss entry timing. There are two dangerous mindsets. I must buy now before I miss out. I must wait until everything is perfect. Both are emotional. Instead ask, does this deal work under conservative assumptions? Does it cash flow at today's rates? Does it survive stress testing? If yes, move. If no, wait. Waiting for structure to align is discipline. Waiting for headlines to improve is procrastination. Now here's a deeper principle. Opportunity increases during fear, but fear paralyzes the unprepared. This is why liquidity matters. When markets contract, Lenders tighten, prices adjust, deals appear. But if you are over-leveraged, you cannot move. If you have reserves, you can act. Timing rewards preparation, not optimism. Now let's talk about refinancing strategy. Refinancing is not reactive. It's strategic. When rates drop significantly, refinance to reduce cost of capital, increase spread. When equity increases, refinance to access growth capital, but only if redeployment produces positive spread. Refinancing to consume is regression. Refinancing to acquire is progression. Timing refinancing requires monitoring markets, but not obsessing. Watch macro trends, understand rate cycles, but always evaluate your structure first. Now here's a powerful insight. Most fortunes are built in downturns. Why? Because assets are mispriced. Fear distorts value. Liquidity becomes king. If you are stable during downturns, you gain asymmetric advantage. But if you overextended during expansion, you are forced into defense. Defense does not build wealth. Positioning does. Now, let's discuss laddering. Instead of buying everything at once, acquire in phases. This reduces timing risk. If you buy over years, you smooth entry points. You reduce exposure to one specific cycle. Laddering reduces volatility impact. Timing becomes less critical. Consistency becomes more powerful. Now here's the subtle truth. People who try to perfectly time markets often do nothing, and doing nothing is the most expensive strategy of all. Inflation continues, opportunities pass, time compounds against them. Strategic action beats perfect timing. Now let's talk about opportunity cost. Every year you delay intelligent leverage is a year compounding, is paused. If your structure is ready, act. If it's not, prepare. But never stagnate, because stagnation is invisible decline. Now here's the core philosophy. You cannot control interest rate cycles, economic headlines, political shifts, global events. You can control debt structure, cash reserves, spread calculation, risk management, emotional discipline. Control what you can, structure for volatility, prepare for downturns, act when math aligns. That is strategic timing. In the next section, we will talk about scaling beyond personal income, because true leverage is not about replacing your job. It's about building systems where income is detached from your time, and that is where real financial power begins. Dear viewer, since you watched this video to the end, you are among the small percentage of people who can appreciate our videos. Please write your rating in the comments, whether you like the video or even what you would improve. We read every comment under our videos, so yours will not go unread. Thank you. Chapter 12, Beyond Income, Building Systems That Outgrow You. There is a ceiling on personal income. No matter how talented you are, no matter how disciplined, no matter how many hours you work, your time is finite. And if your income depends entirely on your time, your growth will eventually stall. This is the hidden limit most people never escape. They use leverage to buy assets, but they still think like employees. They aim to replace their salary, they aim to match their job income with rental income, and then they stop. But true financial power is not replacing income. It's detaching income from your presence. That's a different level. Let's define this clearly. Stage 1 is survival income. You trade time for money. Stage 2 is asset income. Your assets produce cash flow. Stage 3 is system income. Income flows through systems that operate with minimal direct involvement. This is where leverage evolves. Because debt is not just for buying properties, it can build infrastructure, Let's talk about systems. A system is something that produces consistently, with or without your direct input. It may require oversight, it may require adjustment, but it does not require daily labor. Rental properties are systems. Businesses with management teams are systems. Automated digital platforms are systems. Investments with structured reinvestment are systems. The goal is not simply to accumulate assets. It is to build interconnected systems. Systems create scalability. Scalability creates asymmetry. Asymmetry creates freedom. Now here's the shift. When you borrow to buy a single asset, you increase income. When you borrow to build a system, you increase velocity. Velocity is more powerful than volume. Imagine this. You own 3 rental properties. They produce income. That's good. Now imagine you build a property management structure. Standardized processes, clear systems, strong tenant screening, maintenance workflows, financial tracking. Now adding a 4th property does not double your effort. It integrates into the system. Scalability reduces friction. This is where many investors plateau. They accumulate assets without systems. Everything depends on them. Every problem requires personal attention. That's not scalable. That's exhausting. Now, let's talk about business leverage. Borrowing to expand a business is not just about revenue. It's about structure. If you borrow to hire key management, you free your time. If you borrow to build automation, you increase efficiency. If you borrow to invest in scalable infrastructure, you multiply output. The question becomes, does this debt create dependency or reduce dependency? If it reduces your reliance on your own time, it is structural leverage. Structural leverage compounds more powerfully than financial leverage alone. Now let's discuss digital scalability. The modern economy allows something unprecedented. You can build assets that scale infinitely. Digital products, online platforms, licensing models, software tools. Borrowing to expand these systems can create exponential returns. But again, only if structure is strong, only if demand is validated, only if spread is positive. Never borrow for hypothetical scale. Borrow for proven scale. Now here's something important. System income requires leadership, not hustle. You must transition from worker to architect. Architects design systems. Workers execute tasks. Leverage works best for architects because architects think in terms of process, not just profit. Now let's talk about reinvestment cycles. System income produces surplus. Surplus fuels new systems. New systems reduce dependency further. This creates exponential autonomy. At this stage, your income no longer fluctuates with your effort, it fluctuates with your strategic decisions. That is power. But here's the trap. Many build one system. It performs, they relax, they consume profits, they stop optimizing. Systems decay without attention. Markets shift, competition evolves. You must continuously refine. System leverage requires oversight, not micromanagement. Now let's address something deeper. Personal identity. Many people struggle to transition beyond income because their identity is tied to effort. I work hard, I grind, I hustle. But true leverage reduces hustle, and that can feel uncomfortable. You must become comfortable with strategic oversight, not constant motion. Now here's a powerful framework. Every asset you acquire should answer this question. Does this increase my income capacity or increase my system capacity? Income capacity increases cash flow. System capacity increases scalability. Both matter. But system capacity determines long-term freedom. Now imagine this. You have rental income covering expenses, business systems producing surplus, dividend streams generating passive cash flow, debt structured at favorable terms. At that stage, you are not chasing money. Money is flowing through systems, and you are directing allocation. Allocation becomes your primary job, not production. This is where the wealthy operate. They allocate capital, they refine systems, they reposition debt, they analyze macro shifts. They think in decades, not months. Now here's the final shift for this section. Leverage is not about being rich. It is about being structurally independent. Structural independence means your life does not collapse if one income source disappears. Your peace is not tied to a single paycheck. Your time is not sold hourly. Your growth is not capped by effort. That is the real objective. And debt, when used intelligently, accelerates that transition. In the next section, we will talk about the final evolution from leveraged growth to sovereign positioning. Because at some point, you stop needing leverage and you start using it only when strategically optimal. That is financial sovereignty. Chapter 13, Financial Sovereignty. When you stop needing permission, there is a stage beyond leverage, a stage beyond growth, a stage beyond accumulation. It is not louder. It is not flashy. It does not require constant expansion. It is quiet. It is controlled. It is sovereign. Financial sovereignty is the moment you stop needing permission. Permission from banks, permission from employers, permission from markets, permission from circumstances. Let's define it clearly. Financial independence means your income covers your lifestyle. Financial sovereignty means your structure protects your freedom, regardless of volatility. They are not the same. Many people reach independence. Few reach sovereignty. Independence can be fragile. One major disruption, one legal shift, one economic contraction, and suddenly, stability shakes. Sovereignty requires layered protection. It requires optionality. It requires margin. Let's break this down. At the beginning of your journey, you need leverage. You borrow to accelerate. You borrow to build. You borrow to expand. Debt is your engine. But at maturity, debt becomes optional. Not eliminated entirely, but optional. You no longer rely on leverage to survive. You use it only when strategically advantageous. That is power. Now imagine this structure. Your assets generate strong cash flow. Your debt levels are conservative relative to equity. Your liquidity reserves are substantial. Your income streams are diversified. Your expenses are controlled. Your lifestyle does not demand constant expansion. That is sovereignty. You are no longer reactive. You are proactive. You no longer fear downturns. You prepare for them. You no longer chase opportunities. You select them. There is a difference between needing money and deploying money, because behavior follows belief, and belief is silent, invisible, subtle, but dominant. If deep down you believe money is scarce, you will hoard or overspend. If you believe money is complex and overwhelming, you will avoid structure. If you believe wealthy people are lucky, you will never feel in control. Identity dictates tolerance. Tolerance dictates action. Action dictates outcome. This is why some people make more money and still feel broke, because their identity has not changed. Income rose, but self-image did not. So spending rises. Fear remains. Anxiety persists. Wealth does not stabilize. Let's talk about the broke identity. It sounds harsh, but it's important. The broke identity focuses on survival. It asks, how do I pay this bill? How do I make it through the month? What if something goes wrong? It reacts. It fears volatility. It avoids calculated risk. It clings to certainty. And certainty is often small. Now let's talk about the wealth identity. It asks, how do I allocate this capital? How do I strengthen this system? How do I protect and expand this structure? It thinks in decades. It views downturns as opportunity. It views debt as tool. It values patience. Notice something. The wealth identity is calm, not frantic, not desperate, not impulsive, calm. Because confidence comes from structure. Now, here's the powerful shift. You do not wait until you are wealthy to adopt the wealth identity. You adopt it first, then wealth follows. This does not mean pretending to be rich. It means thinking structurally. Even if you only have small capital, even if you are early stage, early wealth identity means tracking every dollar, understanding interest rates, evaluating opportunity cost, building reserves intentionally, reinvesting consistently. It is discipline without applause. It is restraint without recognition. It is patience without validation. That is identity transformation. Now let's talk about consumption psychology. If your identity seeks validation through lifestyle, leverage becomes dangerous because increased income turns into increased expenses. You scale consumption instead of assets, and that destroys compounding. Wealth identity prioritizes ownership over appearance, assets over aesthetics, control over clout, freedom over flash. That doesn't mean you live small forever. It means you expand intentionally. You delay gratification strategically because you understand exponential growth. Now here's the uncomfortable truth. Many people subconsciously sabotage wealth. Why? Because wealth requires responsibility. It requires leadership. It requires emotional regulation. It requires long-term thinking. Some people are addicted to chaos, addicted to urgency, addicted to drama. Wealth feels boring, stable, structured, predictable. But boring builds freedom. Chaos builds exhaustion. You must decide which identity you embrace. Now, let's address guilt. Some people struggle to grow wealth because they feel guilty. Guilty for wanting more. Guilty for surpassing peers. Guilty for thinking differently. Understand this clearly. Wealth built ethically through value creation is not harm. It is contribution. When you build assets, you provide housing, you create jobs, you offer services, you increase productivity. Wealth identity understands this. It removes shame. Now let's talk about fear of visibility. As you grow, people notice. Family questions. Friends comment. Critics observe. If your identity is fragile, you shrink. If your identity is grounded, you continue. Wealth identity does not seek approval. It seeks structure. It seeks autonomy. It seeks longevity. Now here's the final identity shift from reactive to proactive. Reactive identity waits for bills. Proactive identity builds reserves. Reactive identity fears downturns. Proactive identity prepares for them. Reactive identity chases trends. Proactive identity builds systems. And this shift happens internally. Before it manifests externally, you must become the person who manages leverage calmly, the person who tracks numbers consistently, the person who reinvests without applause, the person who delays consumption strategically. Because if you don't, you will build wealth briefly and lose it slowly. Identity protects structure. Structure protects freedom. In the next section, we will address the final layer, because beyond identity, beyond leverage, beyond systems, there is one more truth most people ignore, and it determines whether your wealth survives or fades. Chapter 16, integration, becoming structurally unbreakable. Now everything converges: leverage, structure, diversification, timing, systems, identity, durability, philosophy. Individually, they are powerful. Together, they are transformational. This is where the conversation stops being theoretical. This is where it becomes personal. Because understanding these principles intellectually is easy. Living them consistently is rare. Let's integrate. Leverage without identity is dangerous. Identity without structure is ineffective. Structure without durability is fragile. Durability without philosophy is unstable. Philosophy without execution is meaningless. You must weave them together. Let's simplify it. You begin with awareness. You audit your financial life honestly. No denial, no ego, no fantasy. You calculate, you measure, you confront reality, then you clean your foundation, eliminate toxic debt, strengthen liquidity, stabilize cash flow, create margin. Without margin, everything collapses under stress. Then you deploy intelligent leverage, not for status, not for lifestyle, for asset acquisition, for system building, for cash flow engines. You calculate spread carefully. You stress test. You move deliberately. Then you optimize. You refinance when it strengthens structure. You diversify when concentration increases risk. You stagger maturities. You build redundancy. You protect optionality. Then you scale systems. You reduce dependence on your time. You increase process efficiency. You shift from worker to architect. Income detaches from labor. Stability increases. Then identity evolves. You no longer chase. You construct. You no longer react. You allocate. You no longer fear downturns. You prepare for them. Then durability becomes your priority. You maintain reserves. You resist lifestyle inflation. You keep leverage ratios conservative as wealth grows. You think generationally. You build for longevity. Then philosophy stabilizes everything. You see money as a tool. You value optionality over consumption. You respect process over hype. You understand that calm consistency beats dramatic intensity. And finally, you reach sovereignty. You do not need permission. You are not forced into decisions. You are not pressured by volatility. You choose. That is the end state. Not yachts, not applause, not headlines. Choice. Now let's address something honestly. This path is not glamorous. It is not dramatic. It will not impress everyone around you. There will be years where progress feels slow. There will be moments of doubt. There will be volatility. There will be temptation to deviate. But compounding rewards discipline, not excitement. And here is the brutal truth hidden inside this entire journey. Wealth is easy conceptually. Spend less than you earn. Acquire productive assets. Use leverage intelligently. Reinvest consistently. Protect structure. Think long-term. That's it. But it is hard emotionally, because emotions crave speed. Ego craves recognition. Fear craves safety. Desire craves consumption. And resisting those impulses requires maturity. The system is not cheating you. The bank is not your enemy. Markets are not against you. But ignorance is. Impulsiveness is. Inconsistency is. Now imagine your life 10 years from today. If you integrate these principles, you wake up without financial anxiety. Your systems operate. Your income flows. Your debt is structured. Your reserves are strong. Your time is flexible. You make decisions calmly. That is the reward. Not luxury, not comparison. Calm. Security without fragility. Growth without chaos. Power without arrogance. And here is the final truth. No one is coming to rescue you financially. No government, no employer, no miracle. But you do not need rescue. You need structure. You need discipline, you need patience, and you need to begin. Not tomorrow, not when rates change, not when markets stabilize. Now, start small if necessary, but start. Because the only true financial trap is hesitation, and the only real financial advantage is consistent, structured action over time. Build your leverage carefully, build your systems patiently, build your identity intentionally, build your durability deliberately, and one day you will look back and realize something profound. The bank never controlled you. The system was never the enemy. It was simply a set of rules. And once you learn to understand those rules, you learn to use them. And once you use them wisely, you stop being dependent on them. That is freedom. That is sovereignty. That is making the bank work for you. And that is how you build wealth that lasts.